Welcome back, Night Owls. This is Dr. Nighttime, and tonight I'd like to go over risk-neutral pricing for binomial models and how it can be used as a shortcut to more easily calculate some option prices. So let's deal with just an example problem setup. Suppose a stock price is $100 a share now. Each year, the stock price will either increase by 20% with probability 0.6 or decrease by 10% with probability 0.4. The risk-free interest rate is 4% per year. So that means, under these assumptions, we assume that you could borrow or lend at 4% interest per year. What should the price be for a call option on the stock with strike price $115 to be exercised 3 years from now? I guess I should say expiration date 3 years from now, because you still have the option whether or not to exercise it. Now, by a call option, that means you would have the right to buy this stock at $115 if you want to. So, if the stock price is more than $115, then the call option has the value of whatever the difference in price is. And if it's $115 or less, then the option itself has value 0. Alright? So, we'll start with a simpler version. Suppose that instead of looking 3 years into the future, you look 1 year into the future. So right now, the stock price is $100. In 1 year, it will either go up to 120, in which case the call will have a value of 5, or down to 90, in which case the call will have a value of 0. Now, I guess I'll start by talking about one way that you do not solve this problem. You might think, well, if I know that it's got a 60% chance of going up and a 40% chance of going down, then there's a 60% chance that the call value will be $5, 40% chance that the call value will be $0, and so I would find that the the call option price should be $3. And then just you account for 1 year of interest, so you do 3 divided by 1.04. Here's why that doesn't work. Typically, the call value would have to, first of all, the call value would typically have to compensate for the risk or the uncertainty. But also, there's a way of replicating this call option. Notice that if the stock price goes up versus stock price going down, the stock price has a difference in value of $30. Whereas the call value has a difference of $5, right? 5 compared to 0. What this means is that we can sort of view it that the fluctuation in the call price will be 1/6 the fluctuation in the stock price. And what that allows you to do is you could say I could buy 1/6 of the share of the stock. Now, time-wise, you couldn't buy fractional shares. There are some trading agencies where you actually can buy a fractional share, but you could say, fine, if I had a call option on 6 shares, then I could replicate that by buying 1 share of the stock. So if I were to buy 1/6 of the share of this stock, that means I would need to spend $16.67 now. A year later, if the stock price went up, I would be able to sell my 1/6 for 20. Or, if it went down, that means I could sell my 1/6 of a share for 15. Either way, you'll notice that's $15 more than the call value. So because it's always $15 more, it's as if we need to pay back $15. And what this would allow you to do is set up a circular deal. Often when you're figuring out how to price options, you'll try to figure out some sort of circular deal where you could have the option itself and some way of replicating that option, and then you either buy the option itself and sell the replicated option, or the other way around. And I'll illustrate how to do this. Suppose we sold the call option at some price C, and then bought that synthetic call. We bought 1/6 of a share. So that means that right now, you would receive the option price C, right? Because you sold the call option for some price C. And you bought the synthetic call. You bought 1/6 of a share. So right now you receive C and you spend $16.67. If you have to finance that, so if C is greater than $16.67, then you would invest it, but more likely C is less than $16.67. In fact, you know C has to be less than $16.67, right? Because the call option cannot be worth more than 5. So what you do is you borrow at the interest rate, which means later on, you have, so if the stock price goes up, you can now sell your stock share, or your 1/6 of a stock share, for 20. But since you sold a call option, that means somebody else can buy from you at 5. Or somebody else can buy from you at 115, right? So you have to buy something for 120 and sell at 115, so you lose 5. So, looking at this, right now, you'll receive C and spend $16.67. A year from now, you'll receive 20 from selling your 1/6 of a share and lose 5 from the call option being exercised. But of course, that 20 minus 5, that net 15, is 1 year later. You divide by 1 year of interest. And you crunch the numbers, you'll get that the call price would be $2.25. Alternately, in the case that the price goes down, again, you receive C, you buy 1/6 of a share. Now, you can only sell that 1/6 of a share for 15, but then the call option that you sold, that's not getting exercised. The person is not going to buy from you at 115 when they can buy on the open market at 90. You crunch the numbers again, you still get a call price of $2.25. So notice that regardless of whether the stock price goes up or down, that same call option price works. So that means, without actually factoring in the true probabilities, we never said 60% or 40% here, but in either case, you can cover your bases, and you'll notice if the call price were greater than $2.25, right? If you sold for too much, then you could make free money off of that. If the call price were less than that, then you just reverse the terms. You would buy the actual call option and sell the synthetic call. So notice we can always replicate the actual position of this call option. Now, there's another way of calculating that. We can pretend that the stock price has some probability P star to increase, rather than the true probability being 60%. We can say that, going back here, we can say that so the call value right now we calculated is $2.25. We can say that this would be a break-even deal if we were risk neutral and calculated the risk neutral probabilities, right? The probability of it going up or down that would make this risk neutral for us. If that were to happen, then there would be some probability P star that the call value would be 5, and probability 1 minus P star that the call value would be 0. So for it to be neutral for us, this future probability, accounting for 1 year of interest, would get us a value of $2.25. We'll get that P star is approximately 47%. The actual probability of the stock price increasing has no bearing on this P star, and no bearing on the risk-neutral probability, and risk-neutral pricing. Something else to notice, what if the call were for 110 instead of 115? So now you'd have to buy 1/3 of a share, And you'll notice a third of the share price is now always 30 more than the call value. So you'll have to pay back 30 instead of 15. You crunch the numbers again. A third of a share right now is 33.33. You get a call value of $4.48, right? This is to be expected. The call value is going to increase because the individual call values, well, so if the stock price goes up, it increases. If it goes down, it's still zero. But obviously, if it's going to be worth more later, if there's a possibility of it's being worth more and no possibility of it's being worth less, then the current value should be greater. And you can crunch those numbers together. You'll get the same. If you were to solve for the risk-neutral probability, you'll get that same value of 47%. And you can even do that in the case where it's a call value of 0. That's the same as just saying, what's the value of the stock price? So you can do this with the stock price itself, too. If the current price is 100, it will be either 120 or 90. Okay? So when you account for 1 year of interest, 100 times 1.04 would be 120 P star plus 90 times 1 minus P star. Algebra happens, and you, again, get P star is 0.47. So we can think of not only the call value itself going up or down with this probability, but we can view that the stock prices going up or down with this probability. And so when we do the original problem with this 3-period binomial tree, right, so I set up all the possible up and down paths. Now, one thing you could try to do, if you really wanted to do this the hard way, you could say, all right, so these numbers I haven't read, by the way, these are the call values. I'm going back to the problem where the call value is 115. You'll notice these red values are the values of the call option. If the actual stock price is 172.80 and you're buying it for only 115, the option to buy it for 115 has a value of 57.80. Same here. And these two, where the price is below 115, these will obviously have call option values of 0 because you would just never use it. An option can never have a negative value, right? If it's optional, the worst you can do is do nothing. Or worst case, you can do nothing. So you could try to calculate backwards and say, well, what would the call option value have to be here, assuming it went up twice, in order for you to replicate the position here and do that and propagate backward? But that would be an awful lot of work. Instead, what we can say is, I have the standard binomial tree. Probability of the stock price going up each step of the way is P star. Probability of it going down each step of the way is 1 minus P star. So the only way to land at this 5780, value of 5780, is to go up 3 times in a row. So you could say it's 5780 times P star cubed. Then there are 3 ways that you could end up at this 129.60 for a value of 14.60 for the call option. You could go up, then down, up, then down, then up, or down, then up, then up. Right? Hopefully from a probability class or a combinatorics class in high school, you learned about that. So you'll notice that there's a probability 3 times P star squared times 1 minus P star that you'll end up with a value of 14.60. And then, either way of landing here or here, right, any of those, would get you a value of 0. So you crunch those numbers out to get a call value of 1491. And that way you can just say, let's pretend that the probability of it's going up or down was this lower 47% chance to go up rather than the true 60% chance. Notice if the true probability of going up is lower than the risk-neutral probability of it's going up, then the current stock value is overpriced. What that would mean is that you'd be paying extra to incur a risk. And you'd never want to do that. So in that case, you should probably assume that the stock price is going to go down and correct itself, and it might be a good idea to short that stock. But that's not typically the sort of thing they ask about on exam IFM. But they do ask an awful lot of calculation involving this risk-neutral pricing and how to use this risk-neutral pricing or risk-neutral probability to figure out the price of a call option, rather than propagating backward through the tree and doing way, way, way too much algebra for a 5-minute problem. As always, I hope you found this explanation useful. And if you like the way I explain things and want to arrange private lessons, click the link in the description. Until next time, this is Dr. Nighttime wishing you a good night.